how coronavirus will infect financial markets.
Hello and welcome to today's Daily Blitz. Now, in a previous Blitz, while Nikolai was away on paternity leave, I gave the view that commodities were going to get bid up in the near future when China unveils a massive fiscal stimulus plan. They're going to pour huge amounts of concrete, they're going to buy huge amounts of copper and oil, and all of the pain that the commodity market has felt since the coronavirus started spreading around the world, well, that was all going to be sort of relieved, as it were. However, it seems that this might not actually be the case, right, Nikolai?
Yeah, so I'm worried that the opposite's going to happen, that the world is assuming that China will come along with its stimulus and save commodities and a whole bunch of economies and companies, and especially Australia, where I'm originally from. But it might not actually happen. And there's some data or some quotes that suggest that the Chinese are actually considering not implementing the stimulus that everyone is expecting.
So here's this headline from Bloomberg that China vows more fiscal support as virus roils a slowing economy. Would suggest that there would be more fiscal stimulus on the way, but you're not convinced.
No, certainly not. If you actually read the article, it suggests precisely the opposite. So half of the quote from the Chinese Finance Minister Liu Qin was that the government would cut unnecessary government expenses. There are some tax cuts that they have planned, but they're going to be cutting expenses, which is not the typical stimulus that a Keynesian would be sort of advocating. And that is just Bloomberg. If you look at the Chinese media and the Chinese Communist Party magazine, whose name I'm not going to try and pronounce, you'll get the exact opposite conclusion to what the Bloomberg headline is suggesting. So I'm going to read a couple of quotes and we'll have them come up on your screen as well. In China's Global Times, which summarized what the Chinese finance minister said in the Communist magazine, they write, "With the Chinese economy taking a major hit from the outbreak of the novel coronavirus pneumonia, the central government appears to pursue fiscal austerity as part of the efforts to pull through the difficult times. Given the past experience and the financial risks currently facing China, a flood of spending programs seems no longer on the financial regulators' list of choices for stimulating the economy." Quoting the Chinese finance minister, "China will face decreased fiscal revenues and increased expenditures for some time to come, and the fiscal operation will maintain a state of tight balance. In this situation, it won't be feasible to adopt a proactive fiscal policy by expanding the fiscal expenditure scale. Instead, policies and capital must be used in a more effective, precise, and targeted way," Liu said. Liu's article sent a clear signal that China would not stimulate the economy by rolling out another massive monetary stimulus.
Now, there's a certain irony to all of this, because ever since the austerity programs were rolled out in the developed world after the global financial crisis, you found an awful lot of campaigners saying that what the Western world needs to do is develop the Chinese model, the proactive, the pro-cyclical spending programs, which build huge amounts of infrastructure and the like, and prevent the economy from really rolling over and prevent unemployment from spiking. However, it seems that, just as the West has really started to ditch austerity in favor of the China model, China has actually started adopting the austerity model.
That's right, and the question is which one actually works, and it's not clear. But what is clear, and what I think the Chinese are worried about, is that the amount of debt that they've incurred as a result of all this stimulus is really becoming a problem, and that's what they're seeing. So if you look at some of the articles around this stimulus story, you'll find that it's not just about the fiscal stimulus, the taxation and the expenditure. It's also about the banks not foreclosing on people who haven't paid their debts, their corporate debts as well, and it's about not acknowledging the bad debts to try and keep the economy just ticking over after all this stimulus has to be paid for.
Personally, I think that while the financial regulator in China may be talking about austerity policies, I think what they'll find is that they don't really have a choice when it comes to stimulating their own economy by any means necessary. Because the amount of domestic unrest that would be created if you had stagnation in wages, if you had high inflation within the economy, under an authoritarian regime, these things generally don't play out very well for the government. The question is just how much stimulus could China bring to the table if they were forced to, and also what financial markets are really pricing in. And there's one key indicator you should be looking at, right?
That's right, it's the Aussie dollar. The Aussie dollar is practically sort of a proxy for China, basically because the Aussie economy relies so much on China, and the Australian economy actually escaped a recession in 2008 because of the Chinese stimulus at the time. So the Aussie dollar will be a key to sort of monitoring whether the Chinese are going to meet expectations or overstimulate or disappoint.
So watch the Aussie dollar. It's currently closing in on 2008 lows, and if it breaks through that resistance, then you'll know that the coronavirus really is something that the financial markets are starting to price in really quite heavily. But that sums up today's Daily Blitz. Thank you very much for watching. Be sure to subscribe and click the notification bell below, and we'll see you in the next one.